Hello students and welcome on to this second lecture on investment property, and this is now the one where things become a little more interesting and tricky. And this lecture is all about transfers between property, plant and equipment IAS 16 and investment property IAS 40. As always, I have a quote of inspiration. This one was by Albert Einstein, and he said, "Anyone who has never made a mistake has never tried anything new." This is quite a good quote. It always reminds me that making mistakes in some way also means that I am making progress. Because if you don't make a mistake, you haven't tried anything outside of your comfort zone. Right, as an introduction, I would like to bring under your attention that the intention of use of an asset can be changed. So we can have an instance where investment property becomes PPE or property, plant and equipment becomes investment property. So if you think about it, for example, in the first instance, investment property can become PPE in, for example, a situation where you had a building and it was rented out to a lessee under an operating lease. And then this lease has now not been extended or it has been cancelled. And now you have this building. And instead of going back and finding another tenant, you decide that you will rather use this building as your own production plant, or you will have your accountants and your internal audit department move into this building. So in this instance, it used to be investment property. At some point, the lease ended, and you decided as a business owner that you will reclassify it as PPE because the intention of use of this building has now changed. The opposite is also true. PPE can become investment property, especially in times of poor economic performance as we are now currently in. For example, a building might have been PPE. So you might have had a situation where a building was used and you had your administrators and accountants and maybe sales reps. They had offices in this building, and thus it was classified as PPE. But now you've scaled down your business, you had to let go some of your employees, and now you have this random empty building. And if you're a good entrepreneur, you might think about it to find a tenant instead of just having an empty building that is not bringing you any money, yet it's costing you money. So you can find a tenant, and then again, the intention of use of this asset changed once you, for example, find a tenant who wants to rent this building. So this is the two possible scenarios that can happen when we change between PPE and investment property, or investment property and PPE. So the first instance of calculations that I want to explain is when PPE becomes investment property. So when PPE becomes investment property, I've set out steps for you to follow and steps that you need in order to account for this change. So the first step is that you will revaluate the asset. But this is only in the instance, please remember, when you use the revaluation model for your PPE. If you do not use the revaluation model, you use the cost model for your PPE, you will only recognize a depreciation for the period. Then in the second step, you transfer the asset. So in other words, you take it out of PPE and you put it into the investment property account. And then lastly, at the end of the year, you will measure a fair value adjustment either by income or expense, depending on whether this asset has increased in value or decreased in value. So I always say accounting seems very abstract when you talk about it. It's not necessarily something that's easy to explain in words. So I have an example here. So in the example, it is stated that ABC Limited owns a building. On 1 January 2015, the building has the following carrying value. So it was purchased at a cost of 500,000 Rand. It has accumulated depreciation of 45,000 Rand, and the carry value is 455,000 Rand. The building is depreciated over 25 years and it has no residual value. On 1 April 2015, it was decided to reclassify the building to investment property. On 1 April, the fair value of the building was 520,000 Rand. On 31st December 2015, the fair value of the building was 530,000. All right, so now we need to follow the steps. They ask us to draft the general journal entries, to demonstrate the note PPE, and also to disclose the note investment property. So in this solution, the first thing that we are going to do is to revaluate the asset. And how do we approach revaluation? Well, in the first step, we need to depreciate it for the last few months. So that would be, if I look at the financial year, it seems to me like it ends on 31st December 2015. So here I need to go and calculate depreciation for the current year. So I'm going to say the asset had a cost price of 500,000 Rand. It is on a straight line basis over 25 years. And then I am going to count. So it is January, February, and March. The asset is reclassified on 1 April, so that's just one day. We will not count April because one day cannot destitute an entire month. So it is 3 out of 12, which means we recognize depreciation for the last few months before reclassification, and it is 5,000 Rand. So we will debit the depreciation and credit the accumulated depreciation. The second thing we need to do when we revaluate the asset is we need to calculate the total accumulated depreciation for the entire time that we've had the asset up till the date of reclassification, and we need to take it out of our books. So accumulated depreciation is normally a credit balance, so therefore we will debit it and we will write it off against the building, which is the PPE account. So what is the total accumulated depreciation? If we look at the question, at the beginning of the year, it was 45,000 Rand, and we have now just added with another journal entry 5,000 Rand here. So it is the 45 at the beginning of the year plus the 5,000 up till 1 April, and we eliminate the accumulated depreciation by playing it off against the building account. Right, then in the last step, we need to recognize our revaluation surplus. So in this instance, we are going to take the fair value on the date of reclassification, and we're going to play it off against the current value in the books, the current carry value. So we can see in this question that they say the fair value, which is the net present value. Please remember, if you use the revaluation model for PPE, the fair value is the net replacement value, is 520,000. So our current carry value is then this 455,000 at the beginning of the year, minus another 5,000 that we've just depreciated here. So our carry value currently in the books was 450, because it's the 455 minus another 5,000. The net replacement value was 520, which means this asset was worth more than the carry value by 70,000 Rand. We then debit the building PPE by 70,000, and we credit the equity account revaluation surplus by 70,000 Rand as well. All right, so now we've completed our first step. So what needs to be done is in your revaluation, in step 1, you need to calculate the last depreciation for the asset between the last reporting date and the date of reclassification. You need to calculate the total accumulated depreciation and eliminate it from your books. And you need to measure the revaluation surplus and add it to the asset and create an equity account to show the growth in the asset. The second step is then to transfer the asset between PPE and investment property. So if it becomes investment property, we debit the investment property account because the asset grows, and we eliminate the PPE account because this asset will no longer be PPE. You will see that we do this at fair value or at the last or the net replacement value on the day of reclassification. Then in step 3, that is at year end, we need to adjust to do a fair value adjustment. So now we need to keep in mind that this asset is no longer PPE, it is now investment property, and the fair value is 530,000. So we recognized it at the previous fair value of 520,000. It's now 530,000. So there has been a growth of 10,000 Rand. So we debit the investment property and we credit the fair value adjustment income account by 10,000. So these are the steps that we need to follow when we take PPE and we basically reclassify it as investment property. Then the required part also asks that we should demonstrate the note. So the PPE note will look as follows. We will start the note by filling out the information that we have readily available. So they told us at the beginning of the year there was a cost and accumulated depreciation and we had a carry value of 455. We will show the depreciation, the last bit between the last reporting date and the date of reclassification. We will show the revaluation surplus. If there is a revaluation deficit, meaning that the value of the asset when you revaluated it, it was lesser than the carry value, then we will minus it. If it's a surplus, so the value is more, we will add it. And then you show your transfer to investment property, and that is done at the fair value or the net replacement value as on the date of reclassification. You will see at the end of the year we show zeros because this asset is no longer PPE, it's no longer inside PPE, so we are not accounting for it as PPE anymore. The investment property note will look as follows. At the beginning of the year, this asset was not investment property. It only became investment property on 1 April. So then we say under, it's not put, please note, it's not put under additions. It's put under a heading called transfers from PPE. So you show that it came from PPE and you add it, and then you show your fair value adjustment upward. Again, if it was a fair value adjustment expense, the 10,000 would be in brackets to show that it's a negative, and then the closing balance will be as stated for the fair value at the end of the year. Right, so that is what needs to be done. It's quite important for you to just know the steps. So I need to revaluate, I need to transfer, and then I need to fair value adjust. And it's also important to remember that what to do inside the revaluation. You need to measure. I just want to go back to the slide. You need to measure the last depreciation. You need to eliminate the accumulated depreciation. You need to recognize either the revaluation surplus or a revaluation deficit based on the fair value on the date of reclassification. All right, moving along, suppose that we have the opposite, where investment property now becomes PPE. So we reclassify it. It used to be investment property. Now it is PPE. Again, I've set out certain steps that you need to follow. Quite important. So the first step is that you need to fair value adjust the asset. And here you will use the fair value as stated on the date of change or the date of reclassification. In step 2, you will transfer the asset to PPE. And in step 3, you will now reevaluate the asset. All right. So DFE Limited owns a building. On 1 January 2015, the building has the following carrying value. The opening balance in your investment property shows a fair value at the beginning of the year of 800,000 Rand. On 1 April, it is decided to reclassify this building as PPE, and the fair value on 1 April was 850,000. The building is depreciated over 20 years and it doesn't have a residual value. On 31st December, the fair value of the building is 860,000. Please remember at the end of the year, it will now be PPE, so this will be the net replacement value. I would just want to make a note of that. Righto. So for the required, again, you need to do the journals. They want to see the PPE note and they also want to see the investment property note. The solutions will be as follows. The first step is we need to fair value adjust and we need to use the fair value as at the date of reclassification. So it was stated that it was worth 850,000 Rand on 1 April, but at the beginning of the year, the fair value was in the note was 800,000 Rand. So that means the value of the asset grew by 50,000. So I debit the investment property asset, I credit the fair value adjustment, and this is now a fair value adjustment income by 50,000. The second step is I need to transfer it to PPE. So I eliminate it from investment property. I take it to buildings PPE. So I debit the PPE. I credit the investment property asset. And you will see that the transfer is done at the fair value of the date of reclassification. Then the depreciation, then you have to revaluate it. So again, how do we do it? The revaluation is always done the same. You need to measure the depreciation for the time that it was PPE. You need to eliminate the accumulated depreciation, and you need to go and recognize either a revaluation surplus or a revaluation deficit, depending on whether you now have a situation where the asset was worth more or worth less than the net replacement value. Righty. So the depreciation, we can only depreciate it for the time that it became investment property. It became a PPE from investment property. So we take the fair value, we divide it by the 20 years. We are told that the useful life of this asset is 20 years, and then we count from April to December because it became PPE on 1 April. So it was April, May, June, July, August, September, October, November, December. That gives us a total of 9 months, which is depreciation of 31875. I debit the depreciation, I credit the accumulated depreciation by 31875 for the time that this asset was actually PPE. Please remember that this asset was held previously on a fair value model, so therefore you could not measure depreciation on it, but for the time that it was indeed investment property. Then we need to eliminate all the depreciation, so we need to eliminate all the accumulated depreciation, but because the asset has never been depreciated, this is the first time it is depreciated, so the accumulated depreciation account will only contain this one entry, because it's the only time depreciation has been measured. So we debit accumulated depreciation to close this account, and we credit the building. So we basically play off the accumulated depreciation against the building account. Now we need to go and measure the carry value versus the net replacement value. So currently in our books, the carry value of this asset is for 850,000, which is now the fair value at the date of reclassification, minus our accumulated depreciation, and that gives us a carry value of 818125. I need to determine a revaluation surplus or a revaluation deficit. So I take the net replacement value or the fair value at the end of the year. I minus the carry value. So please note how we minus the carry value to get to the revaluation surplus or deficit. Sometimes students want to only minus the cost of the asset or the fair value as on the date of reclassification. You cannot do that. You must use the carry value when the revaluation surplus is calculated. And that gives us a difference upward of 41,875. The building is increasing in value, so we debit the building for 1,875. We credit the revaluation surplus for 1875. Then for the note, what the PPE note will look like versus what the investment property note will look like. So we'll start with the investment property because this asset was investment property and then it became PPE. So I'm going to start with the investment property note. At the beginning of the year, they told us that it was worth 800,000 Rand. On the day of reclassification, we had to recognize a fair value adjustment of 50,000, and then the whole 850,000 that the asset was worth was then transferred to PPE. So the closing balance of this asset in the investment property note is 0 at year end because it is no longer investment property. So it became PPE. In the PPE note, we will say at the beginning of the year, there can be no balances because this asset was not PPE at the beginning of the year. It was only classified as PPE by the middle-ish of the year, by April. So what we will do is we indicate the transfer, and you will see transfer from investment property and transfer to PPE should be the same. So for investment property, it was a minus because we moved it. It was no longer investment property. And for PPE, we added because it became PPE. We minus the depreciation that we've measured on the asset between April and December, and we show the revaluation surplus. By the end of the year, the fair value of the asset was 860,000. Please note how the accumulated depreciation is 0. Why is the accumulated depreciation 0? Because the entire accumulated depreciation that you have calculated here, you have eliminated it against the building account. So you took the whole accumulated depreciation asset value and you played it off. You took it out of the account. So the balance in that account currently is 0, which is indicated here. So the cost and the carry value by year end is exactly the same. All right, I hope that you have enjoyed this lecture, and please make sure to also watch the videos that I have recorded on the specific question types and question examples. I will see you in my next video. Keep well until then.